G'day everyone and welcome back to this Share Cafe Hidden Gems webinar. Only 3 companies today. We lost one last week, unfortunately. Now this webinar series will finish on December 10. So we've still got 3 weeks or so to go. We've got some exciting companies presenting in the coming weeks. Now the one thing we noticed this week is really the increasing role media and social media platforms are playing when communicating about companies. Now, we know traditional media has always exposed corporates in one way or another, but in one extreme, it seems to be becoming a little bit more aggressive. So you had someone like the Australian newspaper, which over the course of the last 2 months has written more than 8 negative articles on Magnus, including 3 in a row this week. So you have to question their motives. And then secondly, this week, you had the ASIC raid on corporate advisory firm Everblue Capital, who was marketing its corporate issues to investors on social media chat groups, with the implication it's paying the owners of these social investment groups, paying them to promote their stocks while holding options on the stocks it raises capital for. A bit like, not dissimilar to what the Market Herald does with the companies it owns and promotes. And then thirdly, you saw Vulcan go nuclear on J Capital following J Capital's short selling report on Vulcan, which was published all over the world. Now, legally now, J Capital can no longer publish that report, but ironically, there's still copies floating all over the internet. Overnight, you saw Standard Lithium fall 20% on a short selling report indicating irregularities around their recovery rates. And that was a report that was published and promoted across the globe. We even spoke this week to someone who wanted to talk to us about opening up some investment channels in China, via TikTok and other social media groups, where we could effectively say whatever we liked about a company under a different brand and without regulation. Now, it's impossible to imagine how ASIC will regulate these channels moving forward, because once something's out there, whether it's factual or not, it's almost impossible to remove from the internet without legal enforcement. And of course, while there's always a digital audit trail for ASIC to follow, it's almost going to be impossible for them to have the resources to know how and where to start. I've just got an email in from Catalyst Hunter. Speak of the devil. So for ASIC, you'd have to think that moving forward, their biggest division will be its digital enforcement team. So it's going to be really interesting to see how this plays out in the future. Now, don't forget to ask questions. Let's make a start. There's only 3 companies presenting today, as I said. First up, we have Traffic Technologies, ASX code TTI, market cap of around $17 million. The company promotes innovative and cost-effective solutions to the traffic industry. The company's had a 1-year return of -26%. We have with us Con Liosatos, who is the CEO. Con, over to you.
Thank you, Tim, and good afternoon to all. My name is Con Liosatos and Managing Director of Traffic Technologies. Could we move on to next slide, please? So for over 15 years, Traffic Technologies has been the leader in hardware and software solutions for road authorities across Australia, New Zealand and abroad. And with the introduction of smart cities and IoT, the company has expanded into what now we have an end-to-end traffic management system across a number of industry sectors. Next slide, please. So these 3 key industry sectors, road authorities, councils and power companies, make us quite unique in what we actually do in nature. So, and this can be delivered, as you can see here, 600,000 devices over 23 countries, 128 cities on 31,000 intersections. Now, some of the countries we deal in, UK, Qatar, Hong Kong, Singapore, China, just to mention a few. Now, out of these, 6.5 million data points are providing required information to key decision makers within these 3 sectors. Next, please. What we have here is our operational cycle, and what drives us are the market requirements, where we either manufacture, develop, or provide a service. Either way, all roads lead back to an IoT device where additional value lies. Now, this is an extremely important point for us, as it is here where we provide analytics from asset condition reports, data analysis, proactive information to the asset owners in councils, road authorities and companies to make these informed decisions. Next slide, please. These are some of our customers that you can see here. We have all road authorities around the country, including in the UK, Transport for London, Hong Kong Highways Department, Land Transport Authority in Singapore, and of course the Qatar roadway itself. And all single councils in Australia, is approximately 357 of them, and 70% of the power companies we deal with. Next slide, please. So here, as cities grow and expand with major infrastructure spending, big data is becoming the key driver in obtaining these desired outcomes for road authorities, councils, and power companies. And with our 4 trigger points that you can see there, 1 in capturing, 2 in processing, 3 analysing, and 4 visualising is the key part here, where people are starting to visualising their data so they can actually make these informed decisions in delivering the outcomes of reducing environmental and financial impact, but increasing safety for the users by the use of our hardware and software. Now, this is all great and fantastic for all new programs, but we also must remember that there's a huge legacy issue of systems and hardware will need to be digitized and upgraded moving forward. Next slide, please. So what we see here is the addressable market worldwide. As you can see, it's enormous. And people like us, TTI, we need to capture value by creating new revenue streams and providing connected solutions and services to our customer base. Now, IoT devices, the Internet of Things and devices, will be increasing the economic impact on reducing operational costs, obviously reducing environmental impact, and driving safety initiatives. I can't stress enough here the importance of this, because everything we do as consumers on our roadways, or commuters on our roadways, I should say, is soon to be connected or will be connected. Next slide, please. Here is a typical example of how actually we approach the market. So this is typically one of our products here, LED street lights, only one of our items that we deliver. And I'll move from left to right with this slide. Stage 1 is we actually sell the product, which is already smart city ready, in this particular case, a street light. Stage 2 is where we provide additional software and sensors. Now, the sensors aren't limited to what you can actually see here in the middle section of the slide. There's a number of different sensors that are used for various different tasks. And then we go to stage 3, which is the final part, and where we're evolving to, which is deliver the software, the hardware, and software as a service framework to have a fully managed service. Next slide, please. Here, I mean, people need to remember we come from a hardcore manufacturing background to now being a hardware and a software provider, delivering on the requirements of our customer base, as mentioned earlier, road authorities, councils, and power companies. I mean, the business continues to evolve with enormous expansion occurring in smart city initiatives in providing software as a service to our customers. I mean, compared to traditional methods here in providing and maintaining infrastructure, software as a service, along with devices, is much less expensive to run and provides better margins and accounts for greater capital efficiencies. Next slide, please. Our key advantages here are that we align ourselves with smart city initiatives across our customer sectors of, as mentioned earlier, road authorities, the 537 councils across the country, and power companies. Our hardware and software is approved across all these 3 sectors, which is very, very, very hard to do, and delivering outcomes and services across New Zealand and overseas. Next, please. FY21 was a good year for us, delivering 18% increase in revenues and 120% increase in EBIT. That has all been led by a lot of recurring revenue that occurred, which is greater than 40% at this stage and growing. Moving forward, we hope to increase that to the next levels. And the long-term contracts have been critical in this. We've started the year in first quarter of 22 very well, and that continues to be as strong for the rest of the year. Recently, it was earlier this month, we completed a $2 million placement, which is all completed, and right now we're in the middle of a rights issue for $10 million. And this will go to the reduction of debt by 10.5, and more importantly is the interest cost saving of up to $1.7 million, which drops straight to the bottom line. Next slide, please. Just an overview here of our recurring revenue, which has been increasing year upon year. This has been one of the company's initiatives with steady growth occurring from FY19. And this has been brought upon by our term contracts in dealing with hardware, software, and maintenance contracts. Now, the important part here, it has occurred across all of our three sectors in dealing with the roadways, councils, and power companies. And as the company evolves into software as a service, we expect further growth in recurring revenue. Next screen, please. So our pipeline here, as you can see, is fairly large. This is purely driven by smart city initiatives on new activity, but also the replacement of old legacy equipment, which is crucial. Now, the company's diversification program has also been instrumental in driving this pipeline, along with government infrastructure programs. Next slide, please. So what we have here is a strong order book of FY22 and beyond. Our demographic and physical policy tailwinds are really strong. Our pipeline with our bolt-on acquisitions of late has been tremendous, and in particular, a small acquisition which occurred at the end of June has delivered a $5.7 million contract with the big giant coach to us, which all that equipment will be deployed by June of next year. Another key part moving forward with growth is the consolidation of our manufacturing bases into one rather than have a multiple, and the planned payment, of course, of our costly legacy debt facility, which drops all back down to the bottom line. Thank you.
Thanks, Con. I think that's the quickest presentation we've ever had. Congratulations. Hey, I've got quite a few questions for you. The first one is you're dealing with a lot of government departments.
Yes.
Is that difficult, and is what you're selling them potentially saving them money?
Yes. Look, what we do, it is difficult in dealing with governments because you are tied to a lot of their safety initiatives, and as I mentioned earlier, financial impacts and environmental impacts. So once you're in and sticky with them and your products and services are pre-approved, where this all takes time, it can take up to 3 to 5 years to be involved with the government to have your wares and services approved. And once you're in, and then your items are prescribed and people have to use your items from there.
And are you signing contracts for what time frame?
3 to 5 years.
3 to 5 years.
Yeah, with extension periods on them as well.
And there's a question here about energy companies. Can you many kind of Internet of Things companies have failed badly with monetizing with energy companies. Can you talk through your experience with those type of businesses?
No trouble at all. With power companies, 70% of the power companies in this country we deal with, we supply all our hardware, which is all smart city ready. So in quite a few cases, we have a number of devices and sensors which are actually bolting on and now moving towards profile. There's actually one big one right now in New South Wales going on. We're looking at software as a service on that to be able to monitor their street lighting, where previously there were people on the road running around trying to maintain the goods. We'd be able to do it remotely and doing it through the software. And you announced a $5.7 million contract. That's is that with Coates Hire? So does that mean that the private sector is potentially clients as well? Yes, the private sector is definitely, and it is Coates Hire. The big giant, after an exhausting process, they chose our product from the newly acquired company that we just did. It's been quite accretive to buy our goods and hardware in our software, and that'll be deployed before June of next year.
And you mentioned you're in a kind of a rights issue. That's to pay down debt. How much debt is on the balance sheet at the moment?
On the balance sheet, there's roughly about 11 million.
11 million
of debt. So we want to distinguish approximately up to 10.5.
Okay, and your EBITDA turned around. Your EBIT turned around very quickly. It was minus 11.4, and then the corresponding year was 2.3. What was the turnaround there?
The key drivers of that were the IoT platforms and our smart city initiatives that we've aligned to out there with the governments. That's been the key driver. Yeah.
And some questions. We've got quite a few questions here. So where does that reoccurring revenue actually come from? What products? Is it in the software, or is it a SaaS and sort of long-term contracts?
It's all of the above. The evolving, I'll hit the last part of it first, being the software as a service. That's the part we're evolving to. As I mentioned in one of the earlier slides, we have over 600,000 devices deployed out worldwide. it's that equipment that's out there right now, which we're actually moving slowly to actually digitize and bring to the forefront. Out of all those 600,000, a good 80,000 have already been digitized. And from there, the software has been compiled onto the units, and then they're ready to be turned on, depending on which area, whether it be a road, council, or power company.
And that breakdown of revenue from within Australia to international, what's that look like?
15% of our revenue last year was offshore, and the balance in Australia. And we consider Australia and New Zealand as one.
Understood. And can you talk about the competitors in this space? I assume it's a competitive space, and kind of where's your competitive advantage in that regard?
Oh, look, it's we do have competitors, but not one across all three sectors. We have individual key competitors in each sector, one of those three sectors. People ranging from the Siemens of the world to the Philips of the world, right through to smaller localized companies in each different sector.
And any plan on acquisitions in terms of growing your revenue through acquisitions?
Definitely, there is a strong blueprint to grow through acquisition as well, but they need to be strategic and they need to be accretive, just like the one we just completed in June.
Okay, and there's a question here around the current pipeline and debt repayment timeline. When does Con expect the company to be profitable, please?
Right. Okay. So I'll go through the debt part first. Straight after the rights issue is completed and the cash is in the door, so to speak, the debt's gone, and then we expect to see that $1.7 million of interest saving start dropping to the bottom line on a monthly basis from there on. As for the pipeline, there's a strong pipeline there, as mentioned earlier, coming from the initiatives of all the infrastructure programs and the smart city, which is expanding day by day. And
any idea of what the gross margin is, if you can tell us on kind of your SaaS sales?
Can't say that.
We've got some smart investors here, Con. They keep coming through with good questions.
I bet they have. Look, there's some things we can't have out there. Some that are very sensitive to where we are. Otherwise, our competitor will start following suit into where we are. So we like to keep things them in-house. And I think over the course of the half-year results, people will start to see the impact of what we're doing.
Understood. And just finishing, where should investors be focused in regards to your timeline? What's coming up that they should be should take note of?
It's all going to be driven around the infrastructure programs. As you know, around the country, things are booming right now. The timelines of some acquisitions and more contracts coming through. It's going to be a really solid year for us.
And I've got a question for you. Could you actually disrupt the lollipop people and bring technology in just to put something in place to manage all that, those gridlocks?
If I could take you into our R&D rooms right now, 100%. That's exactly what you're seeing and what we're driving to. And this is part of the safety initiatives driven by governments in taking people off the road. People don't want to see them. There's been too many deaths over the years of workers on the road and what they do. So we have already developed a portable traffic light system, which can actually lock in and people can actually take off the road and will just pick up on the density of traffic and then change cycles from there. So good question. Really on board. Yeah.
Great, Con. That's all we have time for. Really appreciate you presenting. Have a great end of year and hopefully we'll get you back on 2022 and follow your progress.
Terrific. Thank you, Tim. Thanks very much.
Thank you. Next up, we have Sequioa Financial Group, ASX code SEQ, market cap around $93 million, 1 year return of up 55%. The company is an integrated financial services business, providing products and services to self-directed retail investors, wholesale clients, and third-party professional services firms. We have with us the Executive Director and CEO, Garry Crole. Garry, over to you. Thanks.
Thank you, Tim, and thank you for the opportunity to be here today. I'll start with a disclaimer, which is the first page. It's a little bit different to normal. A lot of people pass by the disclaimer very quickly, but I think the disclaimer is important in respect to talking to what we do. General advice disclaimers basically tell people, look, I'm not giving you any advice. I'm not taking into account any of your personal circumstances. I'm just here to tell you what we are. Have a think about it and go back and go away and make your own decisions. The Sequoia business is all about providing advice and taking into account people's personal situations. And we are looking to lead the industry in respect to advice in all capacities. So I thought I'd just touch on that quickly, but obviously today is about general advice, and I have not taken into account anybody's personal circumstances in this presentation. So I'll just leave it with that one and move on. Today, the purpose of the 10-minute presentation with the group today, from my perspective, is basically just to introduce who Sequioa is. We fly under the radar a little bit in respect to being a small company. We appreciate groups like Share Cafe introducing us to yourselves. And the purpose, if I can do what Warren Buffett talks about and explain our company to you to the point where you understand what we do and you can start to follow our progress, I think today would have been very worthwhile. So that is my ambition, to explain what we do and give you a feel of how we generate our income and how we generate our profit, and look forward to following our ride. I also would like to talk about the last 3 years. In 2019, the board and myself came together and we talked about a long-term strategic plan. I often talk to our existing shareholders about, we are the tortoise, we are not the hare. We are looking to provide consistent growth over long periods of time to actually build a very large company. We recognise we're a small company at the moment with about a $90 million market cap. We do not want to be a small company with a $90 million market cap, but we don't expect to drill a hole and get a gold result and be a major company next year. We have a 3, 5 year, 10-year plan to continue to grow very steadily, increase our EBITDA, increase our net profit after tax, increase our dividends, increase our share price, and slowly look to achieve our long-term goal. And I also would like to, probably the last part of the session, the last 2 parts of the session, is introduce the consolidated parts of our business. We've got 20 different companies within the business with one core function. The core function is to provide the advice industry and the community financial advice in all capacities, and try and help the advice community drive down the cost of advice and assist the community access advice. And that is what we're all about. I'll move to our next slide. The financial results for 2021 were very good. Every single indicator was a positive. We have $116.5 million of revenue in the year 2021, which was 30% increase on the year 2020. So whilst I talk about the tortoise, we are growing quickly, and we expect to continue to grow revenues regularly. A number of the revenue growth this particular year was from some acquisitions. Our organic growth contribution looking forward is 15% in revenue, and we expect that to flow down at a greater rate in our EBITDA, net profit after tax, and so on, as we get greater scale, greater synergies from the business. EBITDA last year was $11.5 million. Our EBITDA is very similar to cash. So we're basically generating $11.5 million of cash each and every year, last year, and that reflects an EBITDA. Net profit after tax and taking away the depreciation was $7.2 million and $5.5 million in respect to net profit after tax. What we are about is, Warren Buffett talks about one of the wonders of the world is compounding. We are looking to generate around about $800,000 to $1 million per month in cash earnings, and we are looking to use that to compound our performance. We are looking for acquisitions. In almost every case, we're looking to use the cash we generate to make acquisitions. We're looking to make acquisitions on PE multiples of 4, 5, and 6 with cash. Where a seller is looking to be a long-term merger type opportunity, we will issue some shares. But really, we're looking to self-generate our cash, use the benefits of compounding, and get that working for us to create returns. The company share price has done very well over the last 12 months, but still at the current share price, we're trading at 6.3 times EBITDA, or around 10 times net profit after tax, which we believe is an undervalued company. I'll look to the next slide, which talks about that a little bit more. The financial results, if you look at the 3-year plan, every single metric is positive. But if you look at the 0.8, the EBITDA multiple that we're now generating is very, very low compared to our peers. If you look at the financial services sector, the average EBITDA multiple is closer to 10. And I think that's a reasonable multiple when you consider the cost of interest and the sort of yield you can get. 2 years ago in 2019, when our share price, when we set this new initiative, our share price was 20 cents. Come 2021, our dividend was 1 cent. So 2 years out, we're looking at a 5% yield. We're not a dividend company, though, I might point out. We are a growth company. We're only looking to pay 20 to 25 to 30%, growing slowly as our dividend distribution. We are really looking to use the compounding effect of generating cash to buy businesses to continue to compound that return, and that is what we're looking to do. So for every dollar, obviously we pay 30 cents in tax. We're looking to pay 25 cents in dividends, but use the 50 to 60 cents in the dollar that we're generating each and every month to go and buy another business. As an example of that, just quickly, we bought a business yesterday for $2.5 million, all in cash. So basically that took us 2.5 to 3 months to generate that $2.5 million of cash to be able to fund it. And that's going to generate an extra $500,000 per annum in operating earnings for us. So that is very compoundingly positive for us, and that is what we're looking to do. The next slide. That's our share price performance. So you can see in 2019, when we reset our goals, we were around the 20 cent mark. We flatlined for a while as the market sort of digested that strategy. But as the numbers started to talk, the share prices started to gain. And as I said before, at the 70 cent price mark where we are now, we're trading at 6.3 times EBITDA or 10 times NPATA. So, in our opinion, we're not expensive. And because of that, we're not looking to issue any shares for businesses that are looking to exit, but we may consider very, very strategic acquisitions in shares, but we're really using cash to make further acquisitions. At September, we had $18 million of cash. We have no debt. So we've got a good cash war chest to make acquisitions. Obviously, that's going to come down with using the $2.5 million for the general insurance business we acquired. But when you're generating $800,000 to $1 million cash, your cash balance is going up very quickly, and we will be looking to make further acquisitions across the various businesses we've got. And I might move on to that slide now, talking about what it is we do. We have four divisions. So wealth is basically licensing financial advisors. The Royal Commission in 2019 came out, and the banks and the insurance companies and the fund managers basically dominated the sector in respect to the number of advisors that they had, and that drove sales into their products. The Royal Commission identified that was a conflict and suggested that the distribution piece and the product piece needed to be separated, which was very good news for us, and it's what I've always believed. And that has seen us able to grow the number of advisors that we have. We have 400 advisors that use our license in the wealth division. They are different types of advisors. So we have the complete financial advisor, who's a financial planner who comes out to your home, or you might go and see them at their office, and they take into account all of your circumstances and give you personal advice. We have stockbrokers who do a combination of that. We have a corporate finance business. We have a family office business that specialises in providing advice to families with more than $5 million to invest. And then we have a general advice only business. The wealth division makes up about 50% of our revenue at the moment. Professional services is basically, and the other three divisions are basically then looking to complement what an advisor needs to provide better advice. And that's where the other three divisions sit. So the professional services business basically does three things. It provides the accounting industry access to legal documents. So when you go and see your accountant, you set up a company, a trust or a super fund, they buy that company or set that company on your behalf. They buy it through businesses like ours. So, Constitute, Doc Centre, NTAA Corporate, Panther Corp, all document businesses. We are moving those businesses to a software as a service, but at the moment it's a commodity that allows us to engage with more than 1,000 accountants and also doing more than 100 documents per day. The Sequioa superannuation business basically does similar. It provides financial planners and accountants the ability to do their self-managed super fund administration on their behalf. Again, looking to reduce the cost of advice by using an outsourced provider that can do it at a lower cost in a more premium manner to allow the accountant or the advisor to actually do what they do best, and that's give personal advice. Equity markets is basically direct to the market investments. So we're an ASX clearer, similar to some of the businesses that you see like Pershing or FinClear, Open Markets, those type of businesses. We clear for 55 AFSLs, which is 55 other licensees. They buy and sell their shares, and we do the back office clearing. So it's very much an administration business. And our direct business is a competitor to, in some ways, to Share Cafe, is the Finance News Network, Sequoia Asset Management, and Sequoia Direct. Move to the next slide. Unlike Con, I'm going a bit too slow. The divisional results, all the numbers heading in the right direction. As I said, the only division that suffered a little bit was our direct division. That was because of COVID. We did a lot of seminars at venues. Obviously, the venues are closed, so we couldn't do as much as that as normal. Move to the next one. I think I've covered this, but again, the wealth division basically is all about the advisors. The number of advisors in the market is reducing, but the number of advisors that we're getting is increasing. The level of demand for advice is absolutely increasing. There is not enough advisors to serve the community needs, and groups like us are well positioned to do that. Next one. Professional services, just in the interest of time. The document business that we have charges $143 per document. Has good 35-40% margins, but we're turning that into a software as a service business. So when somebody sets up a company, we know that they're going to need a terminal to do their, take the money from their clients and pay their bills. We also need that they know they will need general insurance, they'll need secretarial services, they'll need a whole host of services, so that we're looking to add additional product to them. And the direct division being the final division. I'll move past that one, is all about media as well. So we own a business called Financial News Network, which is very similar to the Chef Cafe business, where we provide content for the direct community, and that's a business that we're looking to invest in heavily over the next few years. And probably finally, I might just put a little forecast out. We're 4 months into the financial year. For previous corresponding periods, $52 million revenue first half. We expect that to go to $63 million. EBITDA, we're calling a 20% increase in EBITDA, increase for the prior corresponding period in the first half. Net profit before tax, 25% increase. So as our revenue grows, we're expecting our margins to accelerate. In financial services, the first half of the year is always lower in revenue total than the second half because of a lot of people pay their bills in June and get advice in June. So we always find that the second half is significantly higher. But first half, we're definitely well ahead of the previous corresponding period and ahead of our budget. So I might finish up on that note. Hopefully I've explained a little bit about what we do and give you some colour for that, and hopefully you begin to put us on our watch list, on your watch list.
Thanks, Garry. I got a couple of questions here. We don't have a lot of time, but Morrison's is your self-clearing business, and I think people should be aware that a lot of brokers stop clearing themselves when the ASX put up that kind of working capital requirement. Now, some of your competitors like FinClear, which Magellan's an investor, and then as you mentioned, Open Markets, they're kind of all planning to list. Is there any kind of insights that you can potentially see on the market valuations of these businesses and what that means for Morrison's?
Yeah, well, Morrison's, is one of our 20 businesses, and our market cap is $90 million, and we've got $18 million of cash. Open Markets are looking, as you said, to list at $100 million. We're as big as them. We're more profitable than them. We're growing as quickly as them. So an astute investor would have to suggest that the Morrison's business within Sequioa is very valuable. Just this year alone, our Morrison's business from 30th of June to September is up 35% again. Last year, the revenue was up 100%. It's a business that's growing very quickly, and we're winning market share all the time.
It'll be an interesting business. It'll be interesting business to look at post potential listings for FinClear and Open Markets. And with the financial advice business, I mean, there are fewer advisors and there's more clients to service. How can this area grow without kind of bringing in additional advisors?
Well, it's going to be very difficult. I think, fintech and robo advice and general advice is probably going to take the younger brigade, but there's an enormous shift of wealth coming in the next few years as intergenerational wealth, and people are going to need personal advisors. So it is a real issue for the industry. Groups like us with large distribution forces are going to be inundated with client opportunity for those businesses, making them more profitable. Businesses like us and a number of the others have realised this, and we're trying to drive down the cost for the advisor to operate. And we're hoping come 2024 that we actually start to see the numbers of advisors increase again, because the hard roads that these guys have done to cope with the increasing compliance costs and all the difficulties to run their business might start to get a little bit easier. And those that survive the challenges of the last 2 years and the next 2 years are going to have tremendous businesses, and groups like us will be beneficiaries of that.
And just finally, is there a kind of a target market for you? Obviously, you've got the younger generation with apps being quite active in the market at the moment. Do you plan to attract them to be your clients?
A little bit, but more. I think our market is people who are looking for personal advice and looking for investment opportunities that are a little bit different. The education that a financial planner and a broker and so on has to have gives them a point of difference for their client base. People who have some wealth are prepared to pay for that. And I think that's our market. So I think it's the people with the money that is our market.
Okay, Garry, that's all we have time for. Thanks for coming on. Have a nice weekend.
Thanks for the opportunity.
Next up, we have WestStar Industrial, ASX code WSI, market cap of around 23.5 million. It's got a flat 1 year return. We have with us the managing director, Rob Spadanuda. The company operates in engineering, civil, construction, and mining service industries. Rob, thanks for your time. Over to you.
Thanks for having me. Perhaps we might just start with an introduction. I'm the Managing Director of WestStar Industrial, ASX listed company. I'll provide an overview today on the company's business model, which sees WestStar provide a range of industrial manufacturing and fabrication, installation, construction, maintenance services for the energy, resources, water and infrastructure sectors through its two wholly owned subsidiaries, Simpec and All Type Engineering. Slide, please. So some exciting times for WestStar. The company started out on the ASX in, I suppose, the first full financial year was 2018. And as you can see from the revenue growth that's put on the screen there, we've grown year on year. I think FY21 last year, we got to circa 72 million. FY22 is a very interesting year. You'll see the headline there of $222 million in contracted revenue. We'll attempt today to talk you through some of that revenue and talk you through how it's come about. Slide, please. So some highlights. FY21, as I said, we'll start with the prior period. $72 million revenue, a 15% increase on the corresponding period. It was contributed strongly by the two subsidiaries. We'll get into the two subsidiaries today that make up WestStar Industrial, but they're known as Simpec and All Type Engineering. And as you can see, the revenue split between the two was circa $38.69 million for Simpec and $33 million for All Type Engineering. Delivered an EBITDA of $3.4 million and NPAT of $837K for FY21, which was a big turnaround from the half-year results. Contracts awarded during that period was $72 million. Moving to the FY22 period, which we sit in now, the first quarter we delivered record cash receipts of almost $41 million at the end of quarter one. And that's almost a 20% increase on the last quarter. We recorded a cash balance of $15.2 million at the end of quarter one. Again, an increase of 15% on the previous quarter. We carry zero debt, which is very important. Well, let's just say it's next to zero debt. I suppose I'll take you through a focus on the record-breaking $222 million worth of contracted revenue. We call it record-breaking because that's what it is for the company. One of the major contracts which we'll touch on today is Iron Bridge, which is a $145 million award to Simpec, along with some other awards below. Acciona Waste Energy was circa $10 million for Simpec. In recent weeks, an Albania compressor station for $25 million for All Type Engineering, and as little as last week, a Lynas Rare Earths facility of $12 million. So the company's set up for some serious revenue this financial year. We've just completed a capital raise of $3.5 million during the week, successfully completed to sophisticated institutional investors. Slide, please. So we talk about a value proposition because I think when we reflect on WestStar, we look at the revenue, we look at the cash at bank, $222 million revenue, cash at bank, $15.2 million at the end of last quarter. Added to that, a recent raise of $3.5 million. We certainly see the company as being undervalued at the moment. And some of the highlights here, we'll talk you through while we think that. We've got a proven leadership team, which we'll touch on in the presentation today. Strong capability in delivering large contracts. We've demonstrated an increase geographically. We've worked in New South Wales, established a remote office in Brisbane now through All Type Engineering, and we're growing at a rate of knots. Our reputation with the tier one resource companies we feel is second to none, and we've delivered on many projects in recent times which reinforce that. We've announced some incredible contracts in recent months, and our tender book looks strong, and so the opportunity is there, and we're well positioned for growth. Next slide, please. A brief overview of the group. So WestStar being the parent company, and underneath that sits Simpec and All Type Engineering. Simpec has been with the group for 4 financial years now. It was an acquisition that was done early days. It's grown year on year. It's led by an incredibly strong management team, which we'll touch on during the slides, but predominantly they have the capability of and delivery of structural mechanical piping and E&I work. All Type Engineering is a recent acquisition. Some 18 months ago, we undertook 30-year history, significant presence in the market from a fabrication perspective, and a successful acquisition for WestStar, delivering profitability as we've been moving forward. As you'll see on the left there, they're the subsidiaries and their spaces that they operate in: engineering, construction and maintenance services, fabrication and construction, in the civil, structural, mechanical and piping and E&I spaces. Please, slide, please. So this slide to me is a very important slide. I think it tells a little bit about our history and where we've come from. for this type of business, it's all about building reputation. The jobs just don't land because you're the cheapest price or, your tender's the best tender. You've got to build reputation for delivering work. Our teams in both Simpec and Alltype are led by two very strong managing directors who have a history and experience in delivering very large-scale projects. It is because of them that the projects that we are being awarded now, and it's because of that delivery of their teams, is the type of calibre of projects that we're being provided now, and hence the revenue growth. It comes with bigger projects as you're successful in delivering historical projects. The successful acquisition of Alltype was very strong for the company. It enabled us to grow our order book. And the strategic plan that we've set out to achieve a few years back is certainly probably moving at a rate of knots, as I say, and it's probably ahead of the target. The step change in growth was a highlight for us to increase the contract and order book size. And obviously, with that comes the growth in revenue and EBITDA. Next slide, please. As I touched on earlier, strong management team. The two MDs are highlighted there, which run the two subsidiaries. Very strong history in delivering, as you can see. I won't go into each project, but if you look at the size of the projects, what's important about WestStar and the group, and particularly Simpec and Alltype, is whilst the company has been in operation for some 4 financial years, the history of these individuals and their teams in delivering large-scale projects is a 30-plus year history. So effectively, it's our philosophy is pulling together excellent managers of businesses and excellent teams to be able to deliver strong projects. The public companies up the top there has a CFO and an MD, which is myself, and we like to keep that overhead low, and we provide a governance function to the subsidiaries. Next slide, please. Some of the clients, as you can see, I think the names speak for themselves. We've delivered all of, for all of these clients, successful projects, and we continue to do repeat work for all the clients. And I think that's a testimony to the quality of work that we've been producing. Next slide, please. So just a quick snapshot of some of the projects that we have worked on in recent times. For Simpec, won't go into the projects in detail, but as you can see, they are significant projects. They do demonstrate capability and experience. And some of the more recent ones, the Lynas Rare Earths rotary kiln project that's been awarded to Alltype, and the APA Group compressor station that's been awarded as well. They're two new projects that have just arrived. Next slide, please. So we're going to focus as quickly as we can on Simpec. Simpec's an acronym for those spaces that it operates in. Next slide. What I want to focus on today, very as quickly as we can, is the FMG Iron Bridge project, $145 million award, construction of the wet process plant, significant award for the group. For us, it's about people, it's about capability. We'll talk as quickly as we can through the project itself, but circa 500 personnel required for the project. Recent award, tracking along well. Job has commenced. Literally swinging hammers at the moment on site. Next slide, please. So the scope of works is a major module installation, tank installation, mechanical installation, et cetera, as seen on the slide. $145 million contract, 12 to 13 month program. It's a significant step and testimony to Simpec's ability to deliver projects. I touched earlier on the fact that projects of this nature just don't land in your lap because you've got the right price. It's all about teams. It's all about organisational chart. And we put together, through the managing director, put together a wonderful team to pitch for this project. And there is certainly years of experience in delivering similar projects of this nature. Next slide, please. So we do look at the key risks that are on the project. Procurement is one of the areas. There's a lot of free issued materials on this project. So unlike traditional projects, the procurement risk is taken out of it. We certainly touched on today about the personnel and the capability that we have and the people. A lot of people sort of ask, how do you migrate, 500 people to a project like this? Do you have the ability to do it? I mean, to give perspective, Simpec in its own right has had probably circa 320 people across its sites on different projects nearing completion. So there's a migration element along with new people being recruited to the project. What we can say very confidently today is that all people required for the project are on site. We certainly are very happy with the take up because it's, I suppose, a 12, 13 month project. There's a lot of interest in people wanting to work on the project. The pay rates are strong and it will deliver the right type of people. So we're very confident that we have the people to deliver this project. And I suppose from a financing perspective and a cash flow perspective, we touch on there the ability to be cash flow neutral and our ability to fund the project through bonding. Next slide, please. Again, some of the compelling reasons which I've touched on today: key people, our joint venture with Iron Merge, which is an Aboriginal engagement. These are key reasons for being awarded these types of projects. Health and safety record is impeccable, and again, a key reason. Next slide, please. We could probably move through that one, but this is all types of engineering's background and type of projects it's worked on. Next slide. Yeah. So, I mean, to summarize, we're a highly focused group, highly focused in building the pipeline of major projects. We've got a strong track record of delivery, a strong track record of delivering projects on time and on budget, and a highly experienced management team. Next slide, please. We could probably move through that one as well because we've just sort of touched on, I suppose, board and management. And look, I suppose the summary to this is, and I'm getting the twig that my time's running out, but we're in a very favourable and unique position. Record revenues for FY22, sustained earnings, I suppose, over FY23 would demonstrate a greater period of revenue in what's known as the company's history. And tendering of proposals across the group remains very strong. So we're in this maturity phase of growth, and we're there to deliver long-term sustainable earnings for the group, and that's our focus. Our focus is profitability, and we will deliver these projects and we'll deliver them profitably. And I think that the market will recognise that, and our value proposition will increase. Thanks for the presentation.
Thanks, Rob. Couple of questions here, quite a few actually. There's a lot of talk about inflation in kind of the chain, the distribution chain. Is it becoming difficult to price jobs based on kind of cost price inflation?
Yeah, look, it depends. It depends on the type of projects, but I think that, the way that our types of businesses operate is that we commit time to dollars. So effectively, at the end of the day, prior to signing contracts, you're committing to your suppliers and your subcontractors, and they're committing to you contractually on price. So that's how you mitigate your risk. And if there's any pass-ons that need to occur due to those fluctuations, well, contractually, you've got to cover yourself for those. So that's what we try to do.
And you recently raised a little bit of capital, but you got a healthy cash balance. Why did you do that?
Look, I think we've always tried to be a step ahead of the game. Our cash balance has always been strong. We manage cash very well. As I said earlier, virtually zero debt. The capital raising came about because there's a lot more tendering going on for the group, and we foresee the possibility for working capital and bonding moving forward. It's a function of this industry that we're in. So we don't want to impact our current projects from a cash flow perspective. So by raising, what I would call a small amount, I mean, we could have raised a hell of a lot more. There was a massive take up for it, but it's enough for us to look at these potential projects that that we're tendering and coming on from a working capital perspective and a bonding perspective, so that we can keep growing revenue. Yeah.
And in regards to growing revenue, which would probably mean winning more work, more contracts, what do you need to put in place? Is that more money, or is it more people? Combination of two?
I suppose every contract's sort of intrinsic to itself. So you set up teams on each contract. So for the current contracts, those teams are established and they don't impact on one another. The interesting thing about the model is you've got Simpec and All Type, but I think that that Alltype and Simpec set up teams specific to the project. So we are in a position to be able to take on more work. There's no doubt. And it's by successfully putting teams together that enable you to do that. And you're not pulling on the same set of resources, if that answers your question.
Yeah, and do you think the market's kind of watching to see how you deliver on these big projects in terms of time and profitability?
Absolutely. And we're very aware of that. I mean, whilst there's an element of undervalue, we feel, I mean, I think we've got a market cap today of 24 or 5 million. We've got $15 million cash in the bank. We just raised 3.5. So we're not far from being cash back. We're profitable. We've been profitable over the last 2 years. So the market's looking at us and saying, well, a big project here with Simpec, hence the highlight today. Can they deliver? We try to touch on very briefly today around our mitigation of those risks. We are very positive in our ability to deliver that project. That project, as of today, is running exceptionally well on time. It's a project that will be a feather in our cap. And upon completion of that project, we will re-rate. It's only natural that will occur. And I think that our types of businesses are a function of profitability. So let's deliver the profit. And I think the market cap, so to speak, and the share price will absolutely take care of itself.
And there's some smart questions here in regards to margins. Now, I'm not sure whether you can talk about this. Margins attributed to the contracted $222 million worth of revenue, whether you can give any more colour on that. And what are the gross margins of the contracted revenue?
That is, I think the answer is obvious there. I mean, we get asked that question, but the answer is we can't answer that question. I mean, that's our competitive advantage, and that's it in a nutshell. Yeah. Give that away, and I suppose you give away your operational advantages. So unfortunately, we can't talk to that. But what we can say is that all of the projects we're working on at the moment, and if you look back on our history to try and answer the question around margin, you will see the history of I suppose, EBITDA margins across the financial years. And again, this year you'll see another history of that. I talked earlier about how we keep the parent model low in overhead, so it gives these subsidiaries the ability to deliver the biggest return possible on their projects.
And two more questions. And I think this is a COVID-related question, but how did the labour shortage in WA affect your operations and margin?
Yeah, look, it's an interesting one. There's been a lot of talk about it from, I suppose, a lot more of the tier one companies and the impact that it may have. To be honest, we haven't seen a massive impact. I think a lot of our labour is local. I talked earlier about people and about teams, and I need to reinforce this, that the companies and I suppose the culture that's been developed in these companies, they're big enough to take on big projects. They're small enough to still be personal. And I think at the end of the day, the type of personnel that it's attracted has been traditionally and still today local labour. And we've been very good at doing that and been very good at delivering that. So it didn't really have a massive impact on us. Yes, it had an impact, but not a big impact. And it's not having an impact on our current projects. Our current projects, from a manpower perspective, we are ahead of the curve. Yeah.
And finally, and I'm not sure how many shares are on issue, but there's a question in relation to a share consolidation. Is that on the horizon?
No, there's no consolidation on the horizon at the moment. You asked a question about how many shares on issue. Well, we just issued another 150 million, so circa 1.2 billion shares on issue. I think our focus, to summarise at the moment, is I touched on us raising the cash. I touched on how much cash we've got. If you look at the revenue numbers and you look at the projections around what we have under contract, you're going to see that the revenue is going to increase significantly over the next 2 to 3 financial periods. So, with that comes profitability. That's our focus. No, there is no other focus at this point in time around that. And it's about delivering these projects. That's our pure focus at the moment.
Great, Rob. Well said. Thanks for your time. Have a nice weekend.
Thanks, guys. Thank you.
Thanks, everyone. That's all we have time for. Have a nice weekend. Get out and about, and we'll see you next week.